side by side together with Alan Statakopoulos, who has a broader role and covers professional clients in Finland and Iceland as well. And all this is a part of our expansion outside of our home markets in Norway and Sweden. And we are happy and pleased to see how well we fit in and how well we have been received in these markets and how well we fit in with the demand for sustainable solutions in all these markets. We will actually soon be able to tell more about a big mandate coming in from a client domiciled outside the Nordics, money that will be invested in the strategy that you will hear more about today. And today you will hear more about Storebrand Global ESG Plus, which is a low-cost core global equity holding for climate-aware investors and a kind of alternative to the usual passive investments. And to do the presentation, we have invited Henrik Wold Nilsen, who is the architect behind and the lead portfolio manager for the strategy. Henrik will introduce himself when I hand over the word to him in some few seconds. Since the launch of this strategy in 2016, we have seen how the attention towards passive and climate-aware investment has increased, or perhaps I should use the expression accelerated. And these two strong trends combined with sufficient results in the strategy are the main reasons for the strong growth in asset under management in this specific strategy in the past 4 years. The strategy was actually seeded by an institutional investor from Sweden. It was the city of Stockholm who seeded this strategy with 500 million Swedish kronor. And now this strategy has passed 25 billion in asset under management. And the investor base counts not only institutional investors from the Nordics, but also institutional investors from other European countries. Before I hand over the screen and the microphone to Henrik, I have two final notes. If you have any questions for Henrik, please submit them by using the chat function, and we will come back to all the questions after the presentation. And the last note is that this webinar will be recorded, and you will receive an email with a link to the recording together with Henrik's slides afterwards. And with these words, I will hand over the microphone and the screen to Henrik. We look forward to your presentation.
Thanks a lot. So I hope you can hear me now. I've attempted to mute. It was a bit exciting, the run up to the session today, because my Wi-Fi broke down. So I'm now connected via my hotspot on the mobile phone. That was a bit unnecessary excitement, but hopefully that should be good enough. I think so. And yeah, I'm happy you're joining us today for this webinar. I'll move to the next slide here. Yeah, just a brief introduction of the team which I'm working in. We are a group in Oslo, and we are responsible for the global equity mandates for Storebrand, who is the largest private asset manager in Norway. And yeah, our background is maybe a bit different from many equity teams. So we have more engineering background. Myself, I'm from the particle physicist environment, where I did research, a PhD and postdoc in particle physics before figuring out what can I do except trying to become a professor, and yeah, realized that it's possible to use this skill set in the finance community. And Lars and Geir Magne are the two most recent additions to our team, and they are from a finance background. Lars has a PhD in finance. So next slide. The background story for this product is climate change. And a big question is what to do with investments in oil and gas. It depends upon, well, what temperature target do you want to reach, and also what are then the implications for a given temperature target. And that is a bit dependent on which technologies you assume will become available in the future. But for all Paris scenarios, fossil fuel use has to fall dramatically. And in the figure on the lower left, you see one such projection compatible with 1.5 degree temperature target. The black is coal, dropping like a stone. Oil in brown is also dropping a bit less, and the blue gas is also dropping. So this is what it takes then to be 1.5 compatible. The paper is called Reality Check, and that's because of this figure here on the next click. And that shows from Rystad Energy, so that's like the main go-to source for statements on the oil and gas industry. They have a huge database on all the fields in the world and the plans. And this is the projected change in oil production from today until 2030. If you look at what is in the pipeline from the oil and gas companies, what are their plans? And you can see basically all of them, either like Exxon grows strongly, they plan to increase by 50% the production, or they are flat or slightly increasing. And there is a big gap then between what is being planned for and what is, from a climate point of view, necessary. Being aware of myself being connected via the mobile phone, I'm now going to turn off my camera so that we can use the bandwidth for the slides and audio only. So I'm turning off now. Yeah, so on the next slide, it's a bit of a different topic, but it's more, even more in the media currently, which is the COVID-19 crisis. And this has been, of course, the main story on the stock exchanges this year. And it's also relevant for the fund I'm presenting. So, and the reason is, of course, that people don't travel anymore that much. And this is the scale of the lockdown, which happened during spring as a reaction to COVID. And it shows the fraction of global CO2 emissions, which happens in countries where there was a big lockdown. And you can see this increased up to more than 80% at the peak beginning of April. So of course this had a huge impact on emissions. And these are the global CO2 emissions in metric tons per day, million tons per day, sorry. And you can see this huge and quite unprecedented drop by 17%, but it has rebounded. So the estimate for a year as a whole is -5%, but that's also unprecedented. But we have had reductions before. So this is a graph on the left showing the annual change year by year over the last 120 years. And you can see that the last, so this year is the red thing on the right. And if you go to the left to find the second largest reduction, that was actually related to World War II. Also financial crisis with the red circle around, red dotted circle, was also a reasonably big drop, due of course due to slowdown of global economy. But what happened then after financial crisis was that the central banks and the governments of the world, they tried to get the engine working again, and they managed. So you had a huge spike in emissions the next year, which was the biggest on record. So then the question is, will this drop be permanent, or will you have a similar rebound as during financial crisis when people want to have jobs with a huge spike again and new record emissions? And the international IMF went together with IEA to study this, so both from the money side and the energy side. What does it take if you want to avoid this situation? Because just having more of the same in the economy is not what you need. You need to both restart the engine, but to change direction to manage climate change. So what they did was to make a report in early summer, studying what can you do in terms of stimulus to create jobs, but simultaneously to reduce climate gas emissions. And the result is on the right-hand side in the chart there. So there you have two axes capturing your two targets. So horizontal axis is the number of jobs you create per unit of money spent on stimulus. And the vertical one, that's the price you pay for reducing emissions. So dollars per ton of CO2 reduction. And the number one thing you should do to achieve this dual goal is to stimulate building efficiency measures. So for instance, if you insulate old buildings, at least in cold countries, that's a very efficient thing to do. You create a lot of jobs renovating buildings, and you actually save money. So it's you get money out for each ton of CO2 you save. So it's the perfect thing to do. And yeah, on the further the high right, upside right, there is solar PV. So installing solar power creates also many jobs. There is a price to pay of $30 per ton CO2 saved, but that's actually equivalent on with the current price to emit CO2 in the EU today, this EU quotas. So that's also sort of in the money. So yeah, this shows it's definitely possible to restart the economic engine and also to help climate change mitigation. And EU has been working on exactly this plan, and it was launched, well, it was at least commented on last week by von der Leyen. And the plans now are quite well advanced, and they plan then to, for the EU recovery plan combined with EU Green Deal, they plan to borrow 750 billion euros, and a third of it, more than a third of it, will be spent on climate mitigation. This particular plan of renovating buildings is high up on the list of what they will do. Also, plans for a hydrogen economy have been launched by Germany, France, and lately in Spain, and also UK leaving the EU, but they also have launched similar plans. So this is really a good process in terms of climate action. And there is a think tank here who have collected information on all these stimulation packages from around the world. And this is in the chart on the left. And then they categorize how much of the stimulus has a positive climate impact and how much is just more of the economy as it already is in red. And then you can see China has actually had more a general purpose stimulus without a green color. And the same with the United States. South Korea has a mix, and the European Union is on the best side of this chart with very directional stimulus, which helps for climate. But there is hope for the US because Joe Biden, if he wins, and he's like we know well ahead, he has a plan for spending $2 trillion on climate mitigation action over a handful of years. So him being elected is actually very positive for this space. What have the implications been in terms of market returns due to COVID-19 this year? So what I've done here is to look at MSCI industry groups. So it's one level below sectors that you see more often, but you need to go into finer details to see to separate between winners and losers this year. And it's listed then in the industry groups sorted by the return from mid-February, right before COVID hit the markets, until late summer, end of July. And what you can see is there is a very large spread in returns from software and services up 12%, all the way down to fossil energy minus 30%. And yeah, the pattern here is that everything that you consume from your sofa is up. So software and retailing, mostly being Amazon actually, and healthcare for obvious reasons is well up. On the loser side, it's things related to moving around, so energy and transportation. You also have insurance, which were hit by claims from the pandemic. Real estate, because people don't go shopping and they work from home, so there is less demand for real estate space. And also banks, who typically have a high leverage to the economy. So the pattern here is really that the winners and losers this year are dominated by COVID-19 stories. Another winner segment, which is not really much part of MSCI because most of the companies are really small, too small to be in MSCI, is climate solution providers. So I mentioned in the beginning that for oil and gas, climate mitigation is a big risk. But there is also upside to the climate story. Those who produce renewable energy, energy efficiency, low carbon transportation, recycling, there are plenty of companies who are positioned to benefit from this trend. And they have definitely benefited this year. That's of course due to these green deals that are being talked about, done by EU and on the in the pipeline if Biden is elected in the US. Huge amounts of money entering this fair, and investors have been really positive for these kind of companies this year. It's one of the lone stars in 2020, together with tech and health, I would say. We have a pure play fund for this thematics. It's been a life insurance company portfolio. It was turned into a fund this summer, so a pure renewable fund. Downstairs you can see the performance this year, just illustrating that these are winners. Green is the fund, the flat line blue is the benchmark in NOK, and on the right hand side is relative performance, which is up more than 50% year to date. So this has been a huge winning segment. And of course, this is very good for the product I'm presenting today. So just being a bit ahead of myself, this is just done the performance this year with the same layout as on the previous slide, but now it's the broad low tracking error fund that I'm talking about today, and I will define what this fund is, but just up front, this is what it's been like this year. So it's been a bit better than the benchmark, but yeah, on the right hand side you see the relative performance. It's up +3% before fees. And what was particularly interesting for me this year was to look how did this fund perform during the COVID crisis, because it was a very turbulent market. And as I will show, the idea of this fund is to have a low tracking error vehicle, which can work as a replacement for index funds. And then it's important that it is performing calmly during this extreme risk test, stress test, which COVID was. And you can see during spring it was jumping up and down by more than usual, but that's to be expected in a turbulent market, and there was no strong overall trend. So it worked. Yeah, and overall the trend has been following these two energy down, renewable up trends in the market. Yeah, I'll get back in the end to more attribution, etc. Some of the listeners today are already owning are already invested in the fund, so for them attribution is relevant. For those who don't own it yet, then I guess defining what the strategy is, what the philosophy of the fund is more important, and that's the segment we will take first. So over to the fund itself. What is it? How have we made it? What has been our philosophy, and what are the data sets we use, portfolio construction, etc. Now comes all those details. First, the philosophy of the fund is that the observation that climate change is increasingly an overarching topic in today's markets. It's been trending a lot over the last 5 years. Investors now have the impression they need to have a view on this, both because it's the most important trend for how does the future turn out to be. So it's for a moral reason, it's very important to be onto this topic, but also more pragmatically in terms of the risks and returns and the stewardship of the money you're looking after. This is increasingly becoming the most important topic you need to have a view on. And the aim of the fund is to address the following situation. When we created it in 2016, climate-aware investors who liked low tracking error index funds didn't have much to choose between. There was plenty of renewable energy funds going all into windmills, but that's a completely different risk profile and price level than what index investors want for the bulk of their money. So we wanted to make a strategy which works as a replacement for market cap index funds in an institutional portfolio. And how we do it then is to marry a strong view on climate together with risk management. So we look holistically for as many data sources and views we can have on climate change to get a consistent view. But we are very tracking error adverse. We don't like tracking error, we like index funds. But the index as of today, market cap index, is heavily exposed to climate risk. So that's what we want to adjust. We don't want to leave everything about the index behind and make an active fund, definitely not. But we take the index as a starting point, and then we have very explicit deviations from it, but fully motivated by climate and nothing else. performance-wise, we don't have a performance target. It's not the alpha product, it's a beta product, but we want to give beta to the market, but we also want to give beta to the implementation speed of Paris Agreement, you could say. So we want to consistently be on the winning side if climate mitigation happens faster than the market currently prices in, technically speaking, that is. On the risk side, we are risk averse. We dislike tracking error, we deal with this using a risk minimization process, a risk model, MSCI Barra, and then we force the portfolio to have specific characteristics in terms of climate positioning and sustainability more broadly. But we make sure then that we don't take any unintentional risk from, for instance, being loaded on countries, or sectors, or factors. And all of these points now I will go into more detail. So this was just like the introduction and where are we coming from. And where we are also coming from is a long track record in Storebrand for managing low tracking error index-like funds, but being but having a view on sustainability. And the first step in 2025 was to have a screen. We have a company-wide exclusion list called the Storebrand Standard, where we currently exclude around 8 or 9% of MSCI World. And then we use an optimization technique to find suitable replacements for them. For instance, tobacco stable stocks are replaced by other stable stocks like toothbrush producers, just to give a naive example. And the idea is to try to recreate the full normal MSCI World, but to respect the exclusion list. And this has worked nicely. We have had slightly better return than the benchmark, in spite of reports often saying that SIN stocks are high alpha. We have been able to neutralize this. A second step was including an ESG factor or a rating into index-like fund, tilting on the ESG rating, but while controlling tracking error. And this we launched in 2015 and as a fund in 2016, and it's outperformed the benchmark since then by 0.4% annually. And the last step that Kim referred to in the intro was creating in 2016, co-seeding it with the City of Stockholm, a climate-aware low tracking error fund, which is today's topic. And it's delivered an outperformance of 1.3%, having a realized tracking error just above 1%. And how we do it then? The starting point for all our sustainability investment is engagement and active ownership. And this we do on behalf of all our assets collectively. But it's limited how far you can get. For instance, a pure play coal company will probably stay a pure play coal company. And Exxon, they want to expand production by 50% and they are lobbying against climate mitigation. So, and they also say explicitly they are not very interested in the opinions of climate motivated investors. So it's limited how far you can get with engagement. And for this product, we say that here we divest, we don't own the entire fossil fuel value chain. We also exclude some more companies which are climate negative, though not part formally of the fossil fuel value chain. Instead, the world needs energy also in the future, and we need to save more energy. And that's these climate solution companies that I mentioned, which have been spectacular performance this year. And we have, in 2017, we explicitly allocated 10% of the fund to such companies. Then we use low carbon optimization also, and we have a more broad sustainability rating that we also tilt on. But we combine all of this in a tracking error efficient way. Some more words on the tracking error minimization, because that's a key feature of the product, not only having a strong holistic climate view, but to combine it with risk management. And this is a toy example showing the results of this. First, it's the it's the fund as it would be if you just screened out the screened companies and you had benchmark weights for everything else scaled to 100%. And downstairs, it's the risk you would have, the tracking error. The very downstairs columns, that's the total tracking error in blue from this strategy. And orange is what you get if you use our technique of minimizing risk. So you see that you can get rid of nearly half of the tracking error by not benchmark weighting everything else, but by selectively over and underweighting from a risk minimization point of view. And we dislike tracking error, so that's a good idea to do. And in particular, you see momentum is reduced a lot. And that's because if you don't own oil and gas, you don't own companies with poor momentum. And this you can neutralize then by buying other stocks, which also have been struggling recently to get a benchmark-like profile for momentum exposure. And that's just one out of many ways the system works to neutralize tracking error. Next slide, I mentioned that we don't only exclude oil and gas, but also other climate negative stocks. The CO2 optimization leads to a zero weight in airlines on the left-hand side here. And for comparison, I just show some MSCI strategies, which are partially climate motivated as well. They have low carbon, they have a climate strategy, and there are two versions of the market cap index, world and equity. And you see the low carbon fund, the low carbon index from MSCI shares this property. They also zero weight airlines because airlines emit a lot of CO2. But on the right hand side, there you see airports. So what I've done is to say, if you don't invest in airlines, you don't also want exposure to airports because it's the same value chain. And if one struggles, the other struggles. Whereas the MSCI low carbon actually goes heavily overweight airports, which is probably to neutralize the risk from not owning airlines because they're also tracking error minimizing. So it's a loophole, but we closed the loophole. Meat production. Early last year, we took out pure play industrial meat production because they have big problems with methane emission. On the right-hand side, you see carbon equivalent emissions from different sources of protein, and beef is by far the largest, in particular if you don't co-produce milk. So we took out this then a while ago, and Financial Times just recently, 22nd of September, said that this was the next thing for climate investors, going from fossil to other areas like meat, and we did that already quite a while ago. So this illustrates how we try to move ahead and update the product to stay ahead of the mainstream thinking. Carbon tilting, that has become mainstream. Many investors report on carbon emissions, and it's a good source of climate information, but it's not perfect because it doesn't capture the full life cycle. You don't have very good scope 3 data yet. And for instance, a car producer can have as large carbon emissions in these data, which captures scopes 1 and 2, as for instance, producer of a solar panel, because the use phase isn't captured. And for climate, of course, it's a lot better to invest in solar than in car producers. And here is just an illustration of how this works for a low carbon fund. So it's MSCI low carbon. So upstairs is the equity benchmark, the normal market cap, and it shows the oil and gas sector. And the different colors are the different sub-industries of oil and gas. The orange is the largest, that's integrated oil and gas, and there you have Exxon. And Exxon on the upper right has high emissions because they own the flaring. So that's over 400 tons per million USD. And you can compare that to 190 for the benchmark as a whole. And the lower set of columns is the low carbon version. And that's 80 tons CO2. And then you can see the low carbon achieves the low carbon by staying away from Exxon and similar companies. The orange part is nearly gone. But you go overweight the rest of the value chain. And there you get the blue, which is pipelines. Pembina pipeline being an example. The red, which is Schlumberger and Pierce. They have actually very low carbon emissions because they leave the scene before the emissions really happen. And you have Valero refinery, and the ultimate low carbon oil and gas company is PrairieSky Royalty. They own lots of land in Canada and they lease it out to oil and gas producers. So they are just sending out bills and they have zero emissions, but they have a huge exposure to oil and gas. So does it make sense to do this? No, because these companies are actually can be more climate risky than Exxon. Because Schlumberger are looking for facilitating new oil, they will have problem earlier than Exxon. And this was actually shown during the COVID turbulence. The chart here shows the return of all of the companies on the previous slide during the COVID drop from February to March. Our fund and the benchmark was both down 26%, and Exxon was down 40%. But these value chain companies that you're overweight, if you only tilt low carbon, they were down 60%. So actually, by doing low carbon optimization within the oil and gas industry, you increase your climate risk, you don't decrease it. So it just shows that carbon emissions, scope 1 and 2, is definitely not the full story. But it is useful for many industries, so we do use it, but softly, and we check for consistency that it makes sense. What we also do is ESG optimization. And in Storebrand, we have a broad ESG rating, which captures both the risk and the upside of ESG. So on the risk side, we use Sustainalytics, and on the upside, the SDG score, who can benefit from ESG trends. We use FTSE Green Revenue and other sources of insight for non-climate SDGs. And for this fund in particular, what I've done is to carve out those parts of the rating which is the most relevant for climate. So Sustainalytics, I dig into it and take out the climate part of it and give that a higher weight. And then we use also FTSE Green Revenue to find upside possibilities from climate action. We invest 10% in pure play climate solution companies. It's 126 companies currently. And if you compare that with what you get via MSCI World, there you would only have 23 such pure play companies and less than 1% weight. On the right-hand side, I show this pie chart thing, which shows you the different topics and the weight between them. The largest topic is renewable energy, 35%. Then is low carbon or green transport, 27%. Energy efficiency, 13%. Water, access to water, so building better access to water, so on the hardware side, not the utility side, 12%. And recycling is efficiency for materials, 10%. If we expand it to subtopics, renewable is equally split almost between wind and solar, and smaller contribution from hydro, grid, and hydrogen. And we try to capture as many topics as possible. Yeah, you can go down even one more layer to see the companies. Yeah, and you can see it's spread out with good diversification among 126 companies. And none of them are like very large. It's split into small pieces. And that's because we want low risk, and then you need to spread your bets here. And most of these companies are actually not part of MSCI World. So we have actively then taken them in to the fund because we expect them to become large in the future. But if you want exposure to these already today, you need to be willing to go into the more small cap segment to find them. And we are not trying here to make an alpha fund. So we include them all. We only select them by thematics. What is their product? And then the weights in this part of the portfolio is determined by the risk minimization process, MSCI Barra. And this shows how you can reduce the risk here. And it shows 3 portfolios. Please look at the very lower column. So total active risk below the gray dotted line. And there you see 3 colors, and that's with 3 different manners of gaining exposure to this portfolio. No, sorry, 2 different ways. The gray is what you had if you wouldn't include these 10%. It's a toy example, but that would be the fossil-free fund without climate solutions. And then if you would allocate 10% to the climate solutions, this would give you the orange set of columns. So that's above, it's an increase of 0.2%. But it's, and the reason why the risk increases, you can see on the turquoise arrows above the line, size exposure increases a lot because these are small caps. And value and volatility also increase quite a lot because they are generally more expensive, they are growth oriented. If we then do our risk minimization, what we do is to use the 90% of the fund, so everything else, to lean in the opposite direction. So since we now got more small caps, we buy less small caps with the rest of the fund. And since we have more volatility, we buy less high volatility for the rest of the fund. So this illustrates how you can then get to the blue column. And if you look at the bottom, you can see you take out more than half of the risk that came from this climate solutions exposure. So it's from a risk point of view and also from a cost perspective, this is a lot more efficient way of doing it, to integrate it into a larger fund. because then you can reduce the risk and keep your cost low as well. We have been continuously developing this fund. We launched it in 2016, but it's not a static vehicle. And that's an important point. If you would invest instead in MSCI low carbon or FTSE some climate strategy, it would be a static thing, because they make it when they first launch it, and then it's just updated biannually, but with the same recipe. It's frozen. For our fund, we have a full ownership to the entire methodology, and we do update it as we learn more things. And climate change is a very dynamic story, and every quarter, basically, you gain new insights and you gain access to more data, and then we continuously improve on this strategy. So we have implemented more of these discretionary exclusions to get more consistency. We included the climate solutions in 2017, and we have included FTSE Green Revenue dataset. We have updated the Sustainalytics rating. And currently, I'm working on broadening the exposure to climate solutions by going outside of only pure play companies to include FTSE Green Revenue dataset for the rest of the portfolio, which is not pure play. So if you invest here, you get a continuous improvement process, which we think is a major benefit compared to the index-like products in this segment. On this page, you can see a comparison using Morningstar, our fund, with MSCI World. And you can see climate intensity is less than a third, or around a third. Carbon risk is significantly below the benchmark. Fossil fuel involvement is close to zero. We have a different definition than Morningstar uses. That's why it's not 0.0. In climate solutions, we have more than the benchmark also, not as much as the pure play would indicate, because here you get a lot of additions also from, for instance, Microsoft has green carbon solutions in Morningstar's language. But most of our green exposure comes from pure play companies. ESG rating is also a bit better. And the price to pay is that you have a tracking error then of 1%. And then you can see here comparisons with different MSCI climate strategies, low carbon, and MSCI World Climate Change, which is a newer version. And basically the key takeaway here is that we have a broader climate alignment. So we are improved on all of these metrics, whereas most others are good on a few and then not as good on the others. So that's also what we aim for, to have really a broad climate position. And then it's a matter of how much risk do you have to pay to get this exposure. And what I've shown here is a two-dimensional chart. The x-axis is the expected tracking error in MSCI Barra. Y-axis is your active share, and that's a measure of how much view do you have. The more view you have, the more you deviate from the benchmark, and the higher active share. And the ideal combination here, if you like index funds, is to be on the upper left, because then you have a high view on sustainability and climate, but you have little risk. And that's where we are with our fund, because we are tracking error efficient. So we have an active share of 35%, but less than 1% tracking error. And if you compare that, for instance, with MSCI World Climate Change, they have an active share which is less than a third of us, 10%, but it comes with a risk which is almost 1.5%. And the reason is that they don't manage the risk. They only reweight based on climate, but they don't deal with the risk that arises then. And if you look at peers, fossil-free peers in the Nordics, here are 3 of them, not with names on them, but if you're interested for details, we can share that in one-to-one dialogues, these analysis. But what you see here is that we are to the upper left of all our peers, because we have this tracking error efficiency way of doing the portfolio construction. Just briefly in the end then, I will touch upon performance and attribution for this year. So that's mostly relevant then for those of you who have already invested in the fund. This graph I already showed in the introduction. It just shows that it's been a really good year for the strategy. With low jumping up and down. So tracking error has been moderate, but the performance has been significantly better than the benchmark. This is attribution, showing where does the excess return come from. What I've done is to use data from mid-office and aggregate them together into groups of companies by which exclusion criteria does the company belong to, or is it a climate solution company, or then you have the everything else category, which is all other investments. There is one line called banks and mismapping, and that is a consequence of the mapping and not being perfect, but it's a relatively small contribution. But what it does illustrate is that this is me doing the calculations as portfolio managers, and I have not aimed for perfect mapping here. It would take a lot of work. And that also means that you should interpret this with a slight doses of salt, as we say in Norway. It's not official mid-office delivery, but it's pretty close to the truth. We have also cross-checked with some other sources, like Bloomberg's attribution tool. The key takeaway here is that this year, the main contribution has been plus 2.9% from fossil-free. The Storebrand standard, mostly the weapons screen, has worked this year, 0.8%. And then the other big contribution is climate solution stocks, which has benefited 1.3%. And I personally ignore currency contributions, by the way, because the fund as a whole is currency neutral, close to. So you see in turquoise, the overall currency effect is 0.3, which is an order of 10 smaller than the other effects. And it's a bit random which of these categories have positive and negative currency contribution, and the optimizer makes sure it adds to close to zero anyway. So it's the equity contribution, the non-currency part, which is mostly reflecting what's going on in my mind. Then you can split this into companies. For fossil, Exxon is the largest contributor, and so on. On the utility electricity production side, we also exclude fossil utilities. And the definition, by the way, of fossil is more than 5% from this activity of revenues. Storebrand standard is mostly the weapons producers are good this year, also because they produce civilian aircrafts. Then you have ethical standard, which is alcohol, weapons, and gambling, more or less neutral this year. Market-oriented standard, that's an expansion using ISS ethics data for international norms and conventions. And that's been a bit negative this year, with Tesla being excluded starting end of Q1. But Wells Fargo has contributed positively, plus 0.3. And then you have these consistency exclusions that I do as a portfolio manager, and that's been slightly positive, but not a big deal. We can also look at the climate solutions. Renewable energy has been stellar, 1.5% equity contribution. What has been in the opposite direction, though, is green transport. That's mostly public transport, because people are afraid to use public transport and they are working from home. So if you're operating buses or railroads, it's been a really poor year. But in aggregate, it's been plus 1.3%. And then we can split it into the hierarchy of subtopics. The best is solar energy, then comes wind, hydrogen, basically everything renewable, but also building efficiency. I mentioned that the EU has a push for renovating buildings, and building efficiency is, for instance, Rockwool in Denmark, NIBE heat pumps in Sweden, and these kind of companies, and they have also contributed nicely. And on the bottom is public transport, minus 0.8%. And single companies, you can look, the top 10 is dominated again by renewable energy. Vivint Solar and Sunrun, they install solar panels on roofs in the US. Zoom Video, we bought that one in January at $70, and currently it's trading at $450. So we had really good timing there. But we didn't try to time it, because we include these companies when we find them, and we don't have a view on company alpha. But we had real luck with that one due to COVID, of course. And on the minus side is mostly railroad companies, a lot of them in Japan, and yeah, it's basically only public transport. Approaching the end here, this is a Morningstar graph showing on the left for the Norwegian domiciled version of the fund, Storebrand Global ESG Plus. It shows comparison with benchmark. We are red, benchmark is the flat line at 0. And then you have peers in 4 categories in gray, sorted by their performance. And you can see the Norwegian vehicle since launch is better than around 80% of peers and a bit better than benchmark. The Swedish domiciled fund was launched 1 year earlier. They have the same strategy, and that's yeah, same picture. Yeah, it's been very good for us in terms of market share and inflows as well, and this just shows this trend. In green is the sum of in and out flows, and blue is the market value that you get as a consequence. Yeah, we have currently almost 40 billion NOK in this strategy, split across the different universes: global developed, emerging markets, Europe, and a Swedish fund. What is available in Norway and Denmark, sorry, is the global developed fund, but we also have an emerging markets fund in Sweden that some Nordic investors, some Norwegian investors are in on. Yeah, just a brief summary then. The key benefits of this product is that it's a dynamic strategy which we update as we learn more things and get access to more data. It's a holistic climate risk management. We combine strong views on climate, diversified set of tools with risk minimization, and we continuously do risk monitoring, not just twice a year when an index is updated, but all the time. And we manage liquidity, and we avoid stock-specific risk and unintended bets. And you also gain access to these 10% of the proprietary climate solutions exposure, which should also be attractive. And there you can capture the upside that comes from climate risk. Yeah, thanks. That's all I had prepared. So I hand over to Kim.
Okay, thank you very much, Henrik. We haven't received any question, but I think I will give you 10 seconds to submit questions if you have any. It doesn't seem to be the case. So if question pops up afterwards, please feel free to reach out to your contact at Storebrand Asset Management. As mentioned in the beginning, we will send you an email with a link to this presentation that we have recorded together with Henrik's slides. And finally, I would just say thank you very much for joining us today. Thank you.
Thanks a lot from my side as well, and have a nice day.